All right, that was a great panel. If you do have questions for our previous panel, they will be out in the foyer to address those in a one-on-one format. So please feel free to go out and say hi to them and ask, because I saw there were several questions in the audience. Our next panel is focused on decentralized finance, and I'll welcome them to the stage, excited to hear what they have to say about blockchain and its role in payments.
Well, I feel like I'm really on film with these lights. We can kind of see you guys. My name is Linda Odom. I'm a partner at K&L Gates. I'm the moderator of this panel. I did want to sit down here. We do want this to be interactive as long as we can keep the flow going. This is a very wide, deep, and interesting topic. So we wanted to have you guys participate. Well, let's introduce the rest of the panel. Jeff?
Hi. Good morning, everybody. Jeff Gapasan. I'm Vice President of Strategy at Atlanta-based Legible. Legible is in the business of making crypto legible. So we provide a translation layer and crypto subledgers that feed into legacy systems such as FIS, Fiserv, other legacy fintech providers that you may have out there as the financial institutions learn to work with the crypto ecosystem. Glad to be here.
Morning, I'm Robert Daniel. I'm at ATDC. ATDC is a over 40-year-old incubator here in Atlanta, down at Tech Square. We focus on Georgia-based companies, finding them from anywhere from I have a business idea, scaling them up to Series A. I'm the FinTech catalyst there, so that means my job is to manage that vertical of FinTech companies that we have, some amazing startups, and that goes anywhere from coaching them to finding new companies to get on our platform and helping them graduate, and also reaching into a fantastic ecosystem that you are a part of. So if you have any desire to work with more fintechs, come see me, and happy to connect you with some cool companies.
Morning, everyone. I'm Dan Nunez-Cohen, Senior Policy and Regulatory Counsel for Crypto.com. We're one of the largest global digital asset financial services platforms. We operate in 90 countries with 50 million users, as well as large institutions. We're essentially one-stop shop in the crypto space as a CeFi or centralized finance company. So we provide buy, sell, custody, transfer, payment services for institutions and retail. We also have an NFT platform. We have derivatives in the United States and abroad, as well as a wide range of other services, including merchant payments. So we work with a ton of players in this space as we allow card payments for our products, as well as contribute to blockchain payments directly. So looking forward to this panel.
Okay, so how many people in the audience work in crypto? Okay, great. How many people in the audience have traded in crypto before? Nice. All right. Any other questions?
How many of you have been involved in DeFi or decentralized finance or smart contracts? Okay.
Okay.
Quite a few. That's good.
All right. So we're going to start slow and basic, but we can speed up and as fast as we need to. We welcome questions. We don't want to leave anybody behind. Robert, why don't you get us started?
Sure. I think there's quite a few out there that didn't raise their hands, so we want to make sure that some of the components that we're talking about today are kind of the glossary of today's topics. So definitely around stable coins, what that means. Gas, it's not the $4.40 that you see down here, but that's what things are trading. It's the cost to trade with Ethereum and some of the other topics that we're going to cover, especially smart contracts as we go deeper into our conversation. Stable coins, for those who might not have raised their hands, are definitely tied to, you've got lots of different stable coins, but obviously you've got the ones that are dollar pegged. So they're tied to the US dollar, a lot more stable than what you'd see with the Bitcoin or Ethereum prices that we've seen over the past half a year now. So those are some of the ones that we'll look at as we talk about transactions. And I guess
Yeah, I was just going to add, there are several different types of stable coins that you may have seen or heard of, and some of which, led to some volatility earlier in the market. And so what you'll have is those that are fully collateralized. You'll have algorithmic stable coins, as well as those that are hybrid, which have a component of collateralization as well as some algorithmic component to it. For the most part, if you think about the two most popular stable coins, which are USDC and USDT, those are fully collateralized. And for somebody that came from the world of finance, working in structured and securitized products, I love stable coins and think that they could, set the template for everything that will happen in decentralized finance.
What does it mean for them to be fully collateralized?
So in the case of the collateralization, you have high quality assets, typically $1 for every unit of exchange that's there. So one USDT will have USDC will have $1 or high quality US dollar denominated instrument against it. You will see different variations of this happen. Any of those that are familiar with the most popular stablecoin, Tether, there was news that talked about what exactly they had in their reserves. Was it high quality? Was it commercial paper? Was it any other type of instrument that backed those stablecoins? And so when I think of stablecoins and how they relate to finance in general, I think about the amount of leverage that could potentially be in a system. So with something that's fully collateralized or maybe over collateralized, you have at least one US dollar or one asset that's denominated in a dollar backing one unit that has that same unit of value, right? There is no leverage in that particular instance, or hopefully there is no unit in that leverage in that instance.
How big a deal is it that there are stable coins out there? I remember very vividly when I first learned about stable coins, and it was a relief. How important is it that there's this unique type of cryptocurrency out there?
In my mind, and I'll cede it over to my panel mates here, but in my mind, I think that the stable coins represent something that the crypto ecosystem has looked to embody or develop or show to the consumer public, and that's trust, right? And it's funny to say trust because a lot of what crypto or the crypto ecosystem is based on is trustless transactions. However, if I'm thinking about a stable coin or an asset that has a certain denomination, I have to be able to baseline it against something. And so the importance of stable coins is the ability to understand that there's limited volatility in this particular asset that I'm going to trade or use as a form of commerce in between my entry point, my on-ramp, and my potential off-ramp further down the line.
Okay.
I would say, does everybody know what an on-ramp and an off-ramp is? So an on-ramp is pretty much an easy way for you to get your regular fiat currency onto the crypto blockchain. And an off-ramp is right now much harder to get that money back off from the blockchain. So taking out Bitcoin or Ethereum, still a bit of a challenge, but on-ramps and off-ramps are those capabilities of getting your money on and off the blockchain.
Yeah, so I'll add to that. I agree. Stablecoins, the real value is bridging traditional financial institutions and payments into crypto. And the reason you need that, right, is, current fiat rails do not run on different blockchains, right? There is no connection between the Fed's payment rails or Visa and the Ethereum blockchain or the Solana blockchain or the Bitcoin blockchain. So if you want to engage with those ecosystems, particularly smart contract enabled platforms like Ethereum, right? You want to use different services. You need the native tokens to pay for them, but you don't have those native tokens, right? You need to buy them somehow. But you do have fiat currency, right? You have US dollars, you have euros. So a stablecoin is a way to on-ramp into these ecosystems with a medium of exchange whose value you can trust, and as Jeff said, has low volatility. But the benefit is you're able to actually have that payment system run on the native rails of whatever service you're using. So you're running on the Ethereum blockchain. You can have a USDC coin that runs on that blockchain, the same blockchain that you need to buy Ethereum for different services. So the benefit is 24/7 operation. It's endogenous to that system. There's stability, so you have a clear medium of exchange, but then you can transfer back out into US dollars. So in terms of on and off ramps, major global exchanges like my company, but also FTX, Coinbase, we offer that on and off ramp service, right? We enable users to come onto our platform, use their credit cards, their bank accounts, prepaid cards, to use fiat currency to buy stable coins or other crypto assets that they can then transfer onto native wallets to use for that relevant blockchain, and then transfer their funds back to our platform to exchange them for US dollars. So that way you can have a relatively seamless, or at least more seamless process of using both, whatever payment system you're using in the US, the Federal Reserve, onto a global blockchain-based system, or if you're in Europe, et cetera, and you can easily move between payment systems.
So we're going to get, obviously, to actual DeFi payments, but to Robert's point, we need to make sure that we get the glossary out there. So would one of you cover smart contracts?
Yeah, there's a question out.
Looks like we have an early
Yeah.
question.
Oh, I'm sorry. Yes.
We've got
The lights are bright, yeah.
Yeah.
Question. Are you concerned that quantum computers will destroy crypto, or do you dismiss?
What kind of computer? Sorry.
Quantum.
Oh, quantum computers. Oh, interesting.
That's a heavy hitter for.
If it happens, then yes.
I think it's safe to say that we're probably a few years until we get to that point, but obviously that is a big, discussion point within the venture community as far as, what the impact of quantum computing will be on the cryptocurrency ecosystem.
Is it because it changes it takes the mining out of it?
Well, all encryption. That's the other thing. We probably have bigger problems than just crypto with quantum. We have to rethink all encryption and privacy.
Many very highly credentialed people estimate that we can be quite close to quantum computers becoming a reality. And we know that the financial system needs time to prepare. So do you believe that preparations should start now, or do we have time?
So working at an incubator, I would say there's always the opportunity for evolution. I still think we're fairly early on into blockchain in and of itself, and the industry has the opportunity to evolve. So even with quantum computing, there will be other ways to figure things out. I believe that technology always presents a solution, and we just haven't uncovered that yet.
I agree. I think that we should look into quantum-resistant cryptocurrency. Because we don't want to be surprised and saying, oh, we thought the threat would come 5 years from now. Not right, it's a problem. So just wanted to mention, the threat is there, and there are technologies, we all want that quite offer quite a few options for quantum-resistant technology that should be looked at in order to ensure unity in the digital revolution.
Yeah, that's a great question, and happy to follow up after the panel. Thank you. I think you were getting into smart contracts there. That was your next component. So smart contracts, you'll hear quite a bit of that today. Smart contracts are not that new. It was coined in the mid-90s, but it's essentially taking everything that you have with a regular contract and pretty much automating it. So there's components where there's an event that happens, and then payouts automatically occur. So it's an excellent way to execute that on the blockchain. A lot happens through Ethereum. One of the interesting things about a smart contract, though, is it does not have to have an ownership of a person once it's out there. It's written in code. It's bits and bytes out there that no longer belong to the person who necessarily wrote it. A lot of these things are open source as well, so that presents a challenge with security issues sometimes, but as the code gets better, the security gets better. So again, I think one of the things to remember about the smart contract is anybody can interact with it. It's automatically built into the code, and it no longer is owned by one particular person.
And what do smart contracts have to do with DeFi payments?
So smart contracts is how DeFi payments can even exist. It's how to automate payment streams. So you can use smart contracts to facilitate any crypto-based payment on the relevant blockchain. So to Robert's example, Ethereum, if you want to send an Ethereum-based token from one person to another to pay for a service, and that person sends it on to another, you can use smart contracts to automate that system, that flow of payments, if you will. So you could do that B2C, peer-to-peer, B2B. All you have to do is program into the smart contract certain parameters, right? So you could do, date, time, price, for instance, that says, if at this date and time, this good or service hits this price, we'll automatically, Dan will pay Linda, and then Linda will pay a portion of that to a third party. And the second those parameters hit, the smart contract will automatically execute your transaction 24/7, 365 without human intervention. And to Robert's point, in some cases, you can't intervene. So that's a big critical distinction with DeFi payments versus traditional payments, right? There is no clawback. Right, we're all familiar with, if someone, a consumer says, there was fraud, there's unauthorized ACH, you claw back the funds, the ACH system is able to get the funds back. Not so much with smart contracts and most DeFi payments. By and large, payments are final. So there's a higher level of scrutiny that's necessary for DeFi payments and certainty that's can potentially offset some of the benefits of 24/7, 365 automated, instantaneous settlement and clearance.
Dan, do companies like yours partner with merchants at this point to help them with payments?
We do. Actually, our and the whole industry's relationship with traditional banks, payment processors, and other in the payments industry is truly critical. Because again, we're an on and off ramp. So we allow fiat-based payments into and out of crypto, and we partner with banks and payment processors, for instance, for our prepaid Visa card. We're not the only one. A lot of major companies in the space have either credit cards or debit cards that they issue with banks over the Visa rails. They work with payment processors. We also have merchant processing systems for crypto directly. We create wallets for merchants. We create wallets for consumers, and we allow our consumers to buy goods and services from the merchant in particular crypto, and the merchant can either choose to hold that crypto if they choose, or instantaneously cash it out for fiat. And whenever we do that, right, we are a money transmitter, so under our licenses, we have to hold fiat or T-bills or commercial paper so that we can facilitate that liability, and we work with our bank partners to do it as well. But we do this for merchants, we do it for consumers, and if people want to only have fiat, that's fine. If people only want to have crypto, that's fine. But it's part of what makes DeFi payments work is the integration with traditional finance.
For those of you involved in the cryptocurrency industry, are any of you involved in payments in this way, DeFi payments? I know you, so I'm gonna see if anybody else is there first because we've already talked. All right, why don't you give a little bit about what you do?
So we're Covenant Pay, and we have a platform that's sort of an aggregator payment gateway, connects to multiple processors, requires other multiple gateways, and we process BTC across Lightning.
Okay.
And working with a couple of other partners to get into more on the Ethereum side.
Okay. And are you able to, do you have wallets? I mean, do you have a,
Yeah.
okay.
We provide wallets to our merchants.
Okay.
We've also got an on-ramp, off-ramp aggregator that we're in the process of working with. I'm probably going to reach out to you guys.
Yeah, please do. Always looking for partners.
Okay. Anyone else?
In the back.
Yeah, in the back?
I think people can't hear.
We have a leading investment management firm, taking crypto as an asset class,
Sure.
and we build a platform for them.
Oh, nice. That's great. Okay, so does anybody have any questions about what we've talked about so far? Yeah, go ahead.
Yeah, so in the layman's term, right, the stable coin is basically stable, right? It's pegged against a currency, for example, USD, but we know that recently the Terra USD, right, which has collapsed. So how as an investor, as a buyer, you ensure that, okay, it's a stable coin, but it would not collapse, right?
And that's a great question. If those that aren't familiar, Terra was one of the stable coins that had some challenges earlier in the year. And Terra was an algorithmic stable coin. And so, one of the things that is incumbent on anybody that's in crypto, and I tell this to anybody that's in any type of asset class, is to read, the fine print, because, Terra was one that didn't necessarily, advocate or talk about the risks that were, inherently there. But algorithmic stable coins, they operated on the basis of, depending on, how much inflow was happening in one certain currency, that currency would get burned or destroyed in order to mint another currency to allow for some self-leveling or some self-actuated type of, valuation or value kind of storage level. What happened in that particular instance was that the algorithm didn't work. Just like anything in finance, there was an arbitrage that occurred when the different, rules that were set in terms of how this would operate, would function. And so that in that case, it was not a, fully collateralized or even anything collateralized type of stable coin that occurred or that was there. There are also other stable coins, Maker, which is, oftentimes over collateralized at 1.5 times the, value of that particular coin. And so, in that particular instance, you can say that, coin has no inherent leverage there or, risk due to the leverage component of the, of the equation.
Another question I have, like, say, if you want to purchase or trade in a currency, right? Sorry, a cryptocurrency, right? Then there's any blockchain, right? Ethereum blockchain, Solana, Polygon, and all those, right? So do you think that there will be a sort of an oracle wherein you can easily, trade between across the blockchains?
So I'll take that. So if you want to trade across blockchains or different assets, you really have two avenues. You can come to like a centralized exchange, and you can buy any asset. But what you're really doing when you do that is you're having off-chain transactions. They're book transactions. So you're using whatever asset, fiat or other crypto, to buy, let's say, Solana. So the Solana blockchain will reflect ownership of the exchange, but it's held in benefit for you. But when you want to withdraw, then the exchange will transfer that Solana asset to whatever Solana-based wallet that you have. If you want to use a non-hosted wallet, right, software to interact with the blockchain directly, and you want to go cross-chain, so let's say you have an Ethereum wallet, you want to buy Solana, you either need to go set up a separate Solana wallet and buy Solana through that wallet, or you need to use a bridge. And a bridge is essentially software or a centralized provider that creates a mirror token, which is an IOU. So you freeze your asset on the Ethereum blockchain, and you are given an identical asset on the Solana blockchain. Terms often referred to as wrapped tokens. So that's one way to get across blockchains to buy assets, because most blockchains do not communicate to each other. They're parallel systems, similar to how most like payment rails don't. There are exceptions we can talk about later, what are called inter-blockchain, IBC, communication protocols, where certain blockchains can communicate, so you can move the same asset across to a different blockchain without creating this wrap token, IOU. But all of that technology is still relatively new. Bridges are still relatively new, and not super seamless yet.
I think one thing that's interesting too is as these questions come about is that we talk about the transaction piece of the puzzle, but what's being kind of what people are not really thinking about as well is that there are tax implications that are occurring for every exchange of value that occurs when you do move from something like fiat to Bitcoin to Ethereum. Now what's happening at that point is you're exchanging at a certain value get based against the dollar, and you are actually, incurring either a capital gain or capital loss, depending on, one, how long you've held the token or the asset and have exchanged back to fiat or some other asset and pegged against that, which is where, our company will come in and say, okay, you have to determine your cost basis on any of those transactions. And we've seen, entities that have thousands, hundreds of thousands of transactions, especially in the financial world, and having to decipher, okay, what has happened at these certain points as they've moved either from blockchain to blockchain or traded out of the assets completely.
Yes.
Hey, Linda, Frank Young.
Hey. Oh, hey, good to see you. Wow, it's been a while. We'll have to talk.
So, two related questions, maybe along those lines. So, kudos to Visa MasterCard for getting the entire crypto industry to front their accounts for Visa MasterCard prepaid. Because in essence, our merchants today are accepting crypto, they just don't know it. And I represent Global Payments. We have 3.5 million merchants worldwide, and our position to merchants who ask to get access to crypto, we say, well, you're taking it today, you take a crypto.com Visa card or Coinbase card or BitPay wallet card. Every custodial wallet has a Visa MasterCard that sits on top of it, and the system works exactly as it works today. That does represent a theoretical challenge, but every time I use my BitPay wallet MasterCard, theoretically there's a taxable event occurring if the underlying crypto is acquired at a certain hour. Please don't tell the IRS, but I don't report every transaction I make on my BitPay wallet card. So maybe address that, and then second, I think it would be helpful to get some commentary on the difference between custodial and non-custodial wallets and the role that they play in the future of DeFi. But I just throw those two topics out there.
All right. Thanks, Frank.
Yeah, from the tax basis, it isn't theoretical. I don't know if anybody saw, but the IRS is hiring 87,000 some odd agents over the coming few years. So that'll be interesting to see. But there's also been a high degree of focus on cryptocurrency ownership as a part of your asset or what your income statement looks like. If you look at your tax form for 2021, 2022. There's something they call question 0, which anytime it's in that first block, that blue block at the front that has your name, your address, when you were born, and your social. And oh, by the way, did you buy or sell or dispose of any cryptocurrency? I'd assume that they put a high degree of importance on that particular asset or in that particular question. What that means is that, for those instances where you've used Bitcoin or Ethereum or any other cryptocurrency to buy that cup of coffee, you're essentially taking a capital gain, type of exposure when you do that, or when you make that fiat, or convert to fiat in order to make that transaction. So, that potentially cost you up to 30% more than it did had you, transacted or bought that in dollars, which we don't really, we haven't really kind of thought about because of the fact that I may buy 15 different things, throughout the course of the day, whether it's 2 cups of coffee or what have you. On the custody side, our company is actually working with one of the top 5 U.S. banks that is in the custody space with respect to investment managers and how they are working, on crypto funds and looking at crypto funds and custodial versus non-custodial kind of components of that. I don't believe that crypto and blockchain technology was created envisioning, having a custodian because there's a great saying, your keys, your crypto. Well, in the centralized finance world, being able to have or hire an asset manager that now manages this cryptocurrency fund, then you now have to put those guardrails around this custodial asset or custodial asset to assure that every owner of that particular fund is seeing, okay, every transaction that occurred on the exchange actually has been written to the blockchain and is now, in the wallet that the fund manager has stated. And so there's a lot of there are a lot of details and a lot of systems that have to be kind of maneuvered around, systems which don't envision ever having worked with 18 decimal places that you'll see on the blockchain.
So I'll add to that. I mean, I'm bullish on the future of both custodial and non-custodial wallets for a couple reasons and a couple segments. For retail, it just comes down to preference and sophistication. If you're someone who's very comfortable with technology, understands how crypto assets work, how non-hosted wallets work, a non-hosted wallet is a great option for facilitating payments, for storing assets, for having autonomy. But like Jeff said, it's unforgiving if you do mess up, or if you're using a wallet that has security vulnerabilities. There's not really recourse because it's just software that you're using. So if there's a hack, it's difficult to get your coins back or to get compensation. And I think for that reason, a lot of retail prefer to at least have the option of a custodial wallet, right? Knowing that there is a company or an entity subject to certain cybersecurity standards and liability, protecting their private keys for them, acting as their agent, sending coins to the addresses that they choose. For institutions, absent pretty massive changes in law, at least in this country, I don't see how institutions can use non-hosted wallets, particularly in the asset management space, registered investment advisors, broker-dealers. I just don't think the laws are going to allow for that, and the liability is too great. So they're going to be looking for qualified custodians, right, who have actual technological savvy with these crypto assets, and who are really cutting edge on cold storage. And there's plenty of crypto native companies and more traditional finance companies in that space. So I think in both those realms, you're going to see optionality for both, and a lot of it will continue to be mobile based. So mobile payments, like generally, is becoming bigger and bigger in this country, in e-commerce. I think that's particularly true for wallets, for crypto. People love to pull out their iPhones and be able to send a transaction whenever they want, whether it's custodial or not. So I think both sets of wallets will really continue to focus on mobile-based applications.
Yes.
I wanted to ask about transaction fees and mining fees for cryptocurrency. So I'm not involved in crypto from a banking standpoint, but like as a user, I trade crypto and have a crypto wallet. So one of the main issues with things like Ethereum is that the mining fees can be ridiculous. And then to work around that, you have to spend several days to maybe get the best transaction fee on crypto. So I was wondering if there was something to mitigate that right now, or if there was some type of platform or something like that.
Yeah, that goes back to that gas tax. So you're essentially paying for every transaction, and there's a transaction fee that's, in a good way, it keeps the security level high because somebody can't just come there and hack the system through that. The challenge with that is the fees can be higher, and I guess I don't know of a good way to get around those at this point in time.
A couple thoughts on that. One is you could use side chains or layer twos, so you could use, Polygon, you can use Optimism, Starkware. For those who don't know, these are technologies built on top of a layer one that are meant to reduce transaction costs by lowering issues around like data storage or streamlining execution. Those are significantly cheaper, though they're still subject to supply and demand. So you could ultimately still pay a lot. Certain blockchain networks have different trade-offs in design. So Ethereum really prioritizes decentralization and stability, but not throughput. So you're always going to have higher costs, whereas Solana prioritizes speed. So you're going to have a cheaper cost, or they don't have fee markets. So any blockchain that doesn't have a fee market, but it's a fixed price, that will be cheaper, but you have trade-offs. But if you really, truly want to minimize your costs entirely, a centralized provider is always going to be your cheapest option, because when you keep assets on their system, you're not paying block fees, you're not paying any transaction fee, and then when you do transfer assets off of their system, transactions are typically grouped together. I won't say batched for this crowd because that will confuse things, but so you have a lower fee that's paid. So those are a couple thoughts, but I mean, you're right. Transaction fees will always be an inherent system of DeFi payments.
Especially if you're just trading on a normal basis.
Yeah, for sure. Did you have a follow-up question?
Yeah, I have a follow-up question. So right now, kind of what I'm doing is the side chain solution of working, but is there a security issue with that? Using third parties?
Yeah, so there's security risks to any layer 1 or any layer 2, right? Part of its design. Some are more robust, like zero knowledge proof layer 2s, right? The way they are designed is to ensure more security, whereas an optimistic roll-up is going to be less secure by design. So, part of it is just doing your research and the risks that you want to take. Centralized companies, though, they're going to face the same challenges and risks as most traditional financial companies or banks, right? Are they SOC 2 compliant? Like, are they PCI DSS? Like, are they complying with NIST standards or not? And just checking to see if they are, to take on the level of risk that you're comfortable with.
So you touched a little bit on smart contracts. Can you talk a little bit about decentralized accounts?
Say that again?
Anyone want to take DAOs?
DAOs.
Is that in scope?
Sure.
Yeah.
Yeah.
So there's a question out here about decentralized autonomous organizations, which are known as DAOs. So it's a group of people coming together to create a decentralized organization, and it's almost like a membership that you can buy into, and then at some point in time you hope that will appreciate and you can pop off, and there's some value of participating in it. So it's organizations that kind of have value by being together, and that should increase over time. Should.
Yeah, my simple, kind of take on DAOs is that, we as an American consumer probably spend less time on our finances than we do on travel and vacation planning. And so to assume that everybody will want to participate in the DAO to make, financial decisions for, an investment policy is probably, very high-minded. I think that there are some use cases for the DAOs, but, probably more narrow and more specialist in nature. I've seen DAOs for things like, climate reporting. I've seen DAOs for, different types of special use. But by and large, my sense is that mainstream usage or mainstream adoption of DAOs will probably, be very, very far off into the future, or, non-existent if things like user interface, don't change. I think that, to the conversation that was happening here, and to the point that the gentleman brought up earlier, is that, the legacy financial institutions and financial technology companies have, perhaps the largest opportunity in front of them when it comes to decentralized finance, when it comes to cryptocurrencies and blockchain technologies, and that they are systems and interfaces that the consumer is actually very well versed in using. They are, entities that, yes, they are known. Yes, they do have, and they have had security challenges, but they also offer three things that the crypto companies want: security, safety, and scalability. And so, not to say that every cryptocurrency company that's been, or that's evolved over the last few years doesn't or isn't able to attain that. However, for the large number of them, entities like the networks, like a Visa, like a MasterCard, like a Global Payments, like FIS and WorldPay, they offer the opportunity to provide all three of those things.
Okay, being mindful of the time, I'm going to do a panel poll, and we'll get back to you, okay? I'm going to do a panel poll because we haven't talked about kind of the possibilities and the benefits of DeFi payments. We haven't talked about cross-border. We haven't talked about B2B. We talked some about merchant, retail payments. So I'm going to give each panel member a chance to talk about what they think is most effective today with DeFi payments, keeping in mind what our audience might be able to use and run with and say, wow, that's a possibility for my company. We really need to look at this. So Dan, do you want to start? We'll just come back this way.
Yeah, happy to. So, as we become a more digital economy and e-commerce is the norm, people want to be able to buy whatever they want, whenever they want from their phone or their computer. And they want that transaction to settle quickly, right? There's nothing more frustrating than like getting your Wells Fargo app. Is anyone here from Wells Fargo? I don't mean to call you out, but I'm going to do it anyway. Nothing more frustrating than making a payment, via my Wells Fargo app and then not seeing my account balance change for 1, 2, 3, 4 days, however long it takes if I do it on the weekend, for liquidity management purposes. So I think the big benefit is, being an on and off ramp so that people can use crypto payments for 24/7 payments, whether it's with retail via prepaid card or whether it's buying endogenous service on a network like an NFT, being able to buy an NFT and relatively instantly settle that payment. And then if I sell an NFT, to be able to cash out and doing that instantaneously. So making it faster for folks to be able to convert their crypto assets to fiat through partnerships with crypto exchanges, with banks, with the card networks, I think is very useful. In terms of most like practical use cases, like what are people actually going to be using their assets to buy? Look, I think stable coins via on-ramps can be used for most consumer payments for the reasons we talked about, if they're fiat-backed, centrally issued. But I think a lot of crypto is becoming more and more used for large item purchases, housing down payments for those who have a lot of Bitcoin or Ethereum, car payments, laptops for college, part of college tuition, because a lot of people now have high value in these assets, but as we talked about, transaction costs can be very high, so micropayments don't really make sense, but there will be interest, particularly when tax issues are solved, which Congress is looking at, being able to use some of your wealth in Bitcoin just like you would your stock to pay for college or other things. So helping facilitate that process, that large merchants, large institutions will accept those kind of payments, can do it securely, can cash out to cash, I think is a really important growth area moving forward that really anyone at this conference has some kind of part in playing.
I think for me, it goes back to smart contracts. There's a lot of opportunities that just haven't been scratched yet. There's just a fundamental, amazing idea that you can make money at any point in time. I mean, I think that's what we all strive to do, and that's why we invest in stock markets, that's why we invest in real estate, and have opportunities to have that perpetual income that makes us money, even when we're sleeping. So having the capability of turning different pieces of content into money-making opportunities out there, whether that's songs or movies or components around, it could be even media such as books, art. You have that capability of just having it out there, and just by having some sort of intrinsic value, somebody is just coming along and touching it, and you don't have to worry about whether you're getting paid. That should just automatically trigger. Or if somebody owns an asset and decides to sell it, you could have something into the contract that says, I get 5% of the fees every time that's sold. So it automatically transacts and continues to feed back into your wallet. So having that as an opportunity, I think, is a unique set going forward of what can we monetize from that. I think there's a lot more content that we haven't even kind of discovered what we can put out there on the blockchain from that aspect.
Yeah, when I think of the blockchain, I think of and DeFi and crypto. I think that we look at money and assets, and we look for three very distinct things. One, they're stores of value, or they represent some kind of value that we've invested in them in the past. Two, there's got to be some sort of transportability in which we can actually trade that asset or that currency for something in the future. And lastly, it's a system of accounting. And I think that the last piece is hugely the piece where blockchain technologies can help with what's happening in institutional finance as it moves from wholesale all the way down to retail. With the enhanced kind of capabilities that you have on the accounting side of the blockchain and the ability to have that transparency and visibility, it powers a lot of efficiencies that we haven't to date really taken advantage of. Things like supply chain finance, where a lot of the asset value in any of these invoices is locked in the information that is in each of those invoices. There's a little company in New York, a little bank called JP Morgan that has invested billions of dollars in something called Onyx, which is now being powered to allow payments cross-border and otherwise to happen instantaneously between, let's say, a vendor in the U.S. and the manufacturer in the U.S. and a vendor halfway around the world that could settle almost instantaneously, and you don't have to now rely on letters of credit, bills of lading, any of that. There's also a small company in Bentonville, Arkansas that has attached all of this kind of technology to any of their companies or any of their storefronts that are halfway around the world. Ask any treasurer how difficult it is to get a cash position, but yet they're able to do this at this point in time. So I think that that's the real power, is that accounting kind of functionality there.
I'm going to answer this one as well. As a lawyer, I see things and focus on things that are on my desk, and I deal in cryptocurrency. But when the war broke out in Ukraine, my clients were trying to pay their employees, trying to get their employees out of Ukraine. That takes money. Lots of charities were wanting to get money into Ukraine, and so they had programs and payments and banks and different ways to pay people that were legacy, but those had been cut off due to the war. And it was part of my job was to help them find new ways, and we literally had like presidents flying over to Poland and working with banks and just handing people money as they were coming across the border, and having them sign up so hopefully we can get them virtual money based on their cell phone, and just lots of backflips and twists and turns. And then you read in the paper 3 days later, and millions and millions and millions of dollars had gone to Ukraine, in cryptocurrency value like that, just super easy, just boom. And you're like, oh my gosh, why is that so good, so effective, so immediate? And these other systems are just, there's just very little true ability to handle a situation like that. So it's cross-border, it's quick, it's effective, and there are tax issues, accounting issues. You got to go into it. You got to make sure that you have a fiat-backed stable coin, but it can be a very powerful tool.
I think they all get solved eventually. We do
Yeah.
solve these problems. But having said that, we still have checks 50 years after everybody said that they would no longer be written.
Yeah, and I went to Money 2020, and I can't remember the first one I was starting. It was a different one I went to, and they're like, oh, well, nobody's going to have a wallet in 3 years. It's just going to be the phone, and everybody still has wallets. But okay, so we had some more questions.
Yeah, so if you think that the DeFi is going to be mainstream, in that case, scenario, do you think it's a threat for the current banking or financial service providers, because it removes the middleman out of the equation, right? For any transaction.
It removes the financial service providers from.
Yeah, because if DeFi becomes mainstream,
Oh.
it's a threat to the financial institutions or banks, right? Because it removes the middlemen, which are essentially the banks or financial service providers for any transaction, right? What's your thought on that?
They're involved in the on-ramps and the off-ramps, and then they're involved in holding funds, but they're not the transactors. They're not the main payment transaction mover. If I'm saying that right.
I don't believe, I think it changes the way in which the banks and financial institutions will work within the financial infrastructure, especially with DeFi. I don't believe that, they get, cut out of the picture completely. Otherwise, the financial institutions wouldn't be investing as much in understanding what their specific role will be. There will always be, the need to underwrite credit. There will always be the need to be able to aggregate large, sums of capital. I do think that obviously there is a place for peer-to-peer or more specific, types of fundraising, but there are certain things that the financial institutions will be able to provide in the DeFi ecosystem, and it will not be, completely CeFi, completely DeFi, but somewhere in between.
It's like having a toolbox, You go down, sometimes you need a hammer, sometimes you need a ball peen, sometimes a sledgehammer. There's going to be an opportunity for DeFi, there's going to be an opportunity for traditional financial services, and it's going to be a kind of pick and choose model at that point in time. That's what I
Apple's
see.
kind of famous. Apple's kind of famous for watching and waiting and seeing what everybody else does, and then come out with a really kind of best of breed product. That's what all the banks and financial services companies are doing with crypto. They're watching and waiting and getting ready, to jump in. To Frank's point, there are already people in there. They're making their low risk plays, but there's going to be a lot of scope creep, and the big banks and everybody's going to participate. Yes.
I'm sorry, but we are at time.
Aw.
Minutes